All right, we're back again for a Friday call at the Mooney Lyons. One of the goals of our calls is to introduce you guys, our clients, with the people that we're actually getting advice from uh, as we make recommendations to become good stewards of your money. Today, we're excited because we have Dan with us. He's a CFA with Janice Henderson, runs the ETF specialist department. We're going to talk about everybody's favorite topic, fixed income. So let's just to kind of dive into it. Dan, if you had to look at, I know back when I was in college a couple of years ago, just joking, back the fixed income was defined a little bit differently. So if you look at the fixed income market today, what do you kind of think of, or what does that look like, or what does that mean to you as you're talking to clients and you're teaching new advisors?
Yeah, no, first of all, thank you for having me. Excited to be part of this. You're right. I mean, the fixed income landscape has evolved significantly over the last, even 10, 15 years. And when you look in aggregate and globally, you're north of $50 trillion that kind of gets swept into, what is
Wow.
fixed income. And that can range anything from US Treasuries, which obviously we talk about, the deficit and debt being issued. That is certainly, still the lion's share of the debt outstanding in the world. But you also have US corporations and multinational corporations issuing debt. You have this whole swath called securitized, where loans get packaged up and then, divvied up across different, investor bases for different risk return profiles. That's a big swath of the fixed income landscape. And then you have different credit worthiness. You have, all the way your safest kind of credit profiles, the US government, all the way down to what we call high yield or junk credit. So, there's kind of something for everyone depending on what clients are looking for, but it has certainly evolved over the years.
That's awesome. It has like from the traditional buckets to multiple buckets now. So as we like this hasn't been kind of funny that we've got some younger people on our team, guys in their 20s, and remember talking to them about this thing called inflation. They're like, there's no inflation. Inflation is low, but obviously it's because it wasn't in their lifetime. I mean, if you're in your 20s, it's like a whole different ballgame. But as everybody talks about it, it's all over TV, and obviously we just had a debate a couple days ago. It just as an FYI, I didn't disclaim this on the front. We're taping this the week of September 9th, 2024. But as you look at inflation, how does that impact, or what should people be thinking about when you look at inflation when it comes to fixed income investments?
Yeah, I mean, so the key phrase or word rather within fixed income is fixed, right? The majority of that, the bond market or fixed income market is paying a fixed coupon. So anytime you have periods of higher inflation, that's really reducing the purchasing power. So if I'm earning 5% for my bond and inflation is at 6%, and we were north of that coming out of COVID for a brief period of time, but if it's at 6% and I'm earning 5, well, your purchasing power has been eroded by that 1%. And so the other thing that tends to happen when inflation is rising is interest rates are also rising. And so what that also means, it's kind of a double whammy, is that the price of the bond that you held previously is starting to be worth less, right? If I'm earning 5% from an old bond and now a new bond, because inflation has gone higher, is paying me 7, well, that old bond that was worth 5 or paying 5 should be worth less and is. And we really saw that in earnest in 2022 when you saw really the fixed income market get hit hard as inflation was materially increasing and the Fed in response needed to really aggressively tighten policy.
Oh wow, that's like was that the time frame when they were saying the 60/40 is dead, the 60/40 is dead because you kind of got hit a little there, which obviously everything kind of reverts back to the mean. So on
Correct.
that kind of same topic or role, everybody's worried about the economy, recession, slowdowns, uncertainty, stuff like this. As you look at the fixed income landscape and all these headline noises are hitting, that client that's probably just retired or thinking about retirement, saying, "Hey, should I add fixed income to my portfolio, and have a kind of a balanced portfolio?" What would you say to those people that are like, hey, there's all this noise around me as I look into the fixed income world. What should I be thinking about, or what should I be worried or not worried, or?
Yeah, I mean, again, it goes back to that the fixed income universe is so wide and dispersed in terms of, risk profile, both, credit risk, is the entity that I'm lending money to going to be solvent when I'm getting my principal back? But then there's also interest rate risk. And we really saw the interest rate risk as I mentioned back in 2022, which itself can create a lot of volatility. So, from where I sit, right, there's a couple of different approaches. One is, am I using the fixed income bucket largely as an income bucket and maybe trying to stay ahead of where inflation is and so have positive real purchasing power, and so that may focus me on certain areas of fixed income, whereas others might be focusing on taking less income but higher credit quality, which can really serve as a ballast, kind of that anchor and positive total return when you might need it the most, which is when the rest of your risk bucket, predominantly, stocks, might be going down. So if we think about, are we entering into a period of time where we're late cycle, maybe in the economy, perhaps we tip into a recession, not our baseline, I think generally not consensus baseline, but being mindful that there are different levers that can be pulled within the fixed income landscape to either really preserve and protect and even grow assets on that side if and when equities are falling and risk assets broadly, as well as other areas where I can perhaps take a little bit of credit risk and earn commensurate return in the form of higher yield. So I don't think it's an all or nothing. I think it really depends on how invested a client is on the equity side. And as folks move closer to retirement and then through retirement, clearly it becomes more fixed income, perhaps versus equities. And so maybe it means taking on a little bit more income oriented versus simply, say, US Treasuries, where you're earning less, but it's a safety net during times of stress.
I like that. I like how you use the income bucket too. And then the key concept or my takeaway there is kind of have a game plan of what you're trying to use it for, and then match the investment up to the plan or strategy you're doing. Now, in that, which is awesome, but you used a couple industry terms that I kind of want to, I joke around, we're a teaching hospital here. So all the
Yes.
time. So you use the word credit quality when you kind of go through. So if you were to kind of, for layman's term, what would that mean to somebody that's looking to invest, like credit quality, if they're looking at that? What does that kind of mean?
Yeah, it's kind of, if you think about akin to, consumers are probably well versed in their FICO scores. What is their individual credit score? How comfortable are banks or other institutions lending to consumers? Well, same holds true across the landscape of corporate borrowers. So S&P and Moody's are the predominant credit agencies, and they will look at the capabilities in terms of the revenue and profits of different companies and assign them credit ratings. And then investors such as Janus Henderson, other firms, can then decide, well, do those ratings actually make sense, or do we have a different view of the world? And so when we think about it, it's usually with respect to the US Treasury and the government lending. So that is sort of the risk-free rate for the world. And then when you look at companies, right now there's only three companies who are AAA rated: Apple, Johnson & Johnson, and Microsoft. And then when you move away from that, you start getting into lower credit rated companies. They could still be, very profitable, have high revenues, but not maybe to the extent of Apple, J&J, or Microsoft. And so whereas Apple might have to pay 1% more interest than, say, the US government, as you move farther away into what we call lower credit quality or high yield borrowers, they might have to pay 3 to 6% or even more, than what the US government is able to borrow at. And so you have this tiering system, within a number of different fixed income areas, but especially within US corporations.
I love the FICO score example. I've never heard that. I love it's so easy to understand. Another industry term you popped in there and used it in two formats. Used the term baseline. I think you used it in Janice Henderson's baseline and then consensus baseline. So if you can talk, because I know a lot of times that's used a lot in the media, and I think some of the consumers or clients don't really understand what that means. Like when you're referring to your baseline and then comparing it to another. So can you do like again for like somebody that's not in our industry, what that kind of would mean if they're hearing that on TV or somebody's talking about that, kind of what that industry term means for that?
Yeah, so this is why my parents look at me with interesting look sometimes, perhaps. I try not to use the industry jargon too much. So baseline consensus. So baseline is really sort of what is the most probable outcome, right? It's sort of that's our reference in terms of, okay, if we're assigning, probability of this outcome happening, that the baseline really refers to probably, 50 to 75% chance of happening. Right. And then, moving on that, you start to layer in, well, what could happen to move us away from that higher probability outcome from happening? So that's baseline. And then consensus means, when you have the variety of market participants, so whether it's other asset managers, et cetera, all sort of getting behind a similar viewpoint. So if we talk about the likelihood of a recession in the next 12 months is maybe, 20%. Consensus would say, meaning all of the market participants would say, we're not having a recession. The probability is really low. So that's sort of the delineation between the two.
Okay, so that this kind of leads to my next question. I know the Fed's gonna, I believe, meet next week of this taping. So if you were to look, I mean, you can use the Fed too or not, but what is kind of like I use joke canary in the coal mine. You'd have the canaries in there, and the miners would run out, and the canaries would die. So if you had to look as far as the fixed income world, what's kind of the one or maybe two things that you're like, okay, this is what I watch for to see if I'm really nervous because we get calls as advisors a lot. Are you scared? I'm like, no, 2008 is I was a little scared. I'm not gonna lie, but for the
Mhm.
most part, on all these other ones, we weren't really scared. But is there like a canary in the coal mine, something you kind of watch and say, okay, when this happens, it worries me a little bit, losing a little bit of sleep, but for the most part, there's that metric or thing that you're looking at.
Yeah, I mean, so as I mentioned, as you go into the U.S. corporate borrowers that are perhaps of lower credit quality, called the high yield universe, we look at how much they have to pay beyond what the US government pays in terms of interest. That difference is known as the spread. We look for, periods where that spread starts to increase, what we call spread widening. And so if you think about the broader macro economy and all of the inputs that go into it, if you start to see slowdown happening, if you start to see unemployment ticking higher, and we've seen very modest, but certainly nothing, that even gets close to that recessionary, call. If you start to see that accelerate, well, what that's going to mean perhaps for US companies is they might earn less profit, or they might even get to the point where maybe I'm marginally profitable and I've borrowed a lot of money. Maybe now I'm not profitable and I'm going to have a hard time paying that money back. If that's the case, then the market is going to punish those specific companies, and they're going to punish them by saying, hey, if you want us to lend you money now, we're going to actually charge you 2, 3, 4% more than what we had even previously. And so that shows up in the data basically in real time in terms of where that spread versus US Treasuries is. And so if we get to the point again where you start to have, these concerns, and we saw a little bit of it in early August, it was very short-lived, but you saw markets sell off pretty significantly for a 2-day period and then came back. You started to see high yield spreads start to widen out. So the canary in the coal mine to us is you start to see a much more material uptick in probability of defaults from these more marginal borrowers, which can have sort of a self-reinforcing feedback loop back into the broader economy and so on and so forth. So it's kind of one of the first dominoes to fall and something we absolutely keep watch of.
I like that. I like that a lot. So you brought up August. So as we come towards the fourth quarter here, how do you think the year's been so far in the fixed income world? I know the fixed income world gets it's got a special place in my heart because when we used to do educational programs, that was the area that I started with. Like it was the most overlooked area. Like Joe, you teach that part. So as you look at the year, how do you think fixed income's done as an area, or what do you think's going on so far this year?
Yeah, I mean, I think frankly, even on the equity side as well as fixed income, I think so far we've exceeded expectations, to be honest. I mean, we entered 2024 and everybody was talking about how the Fed is going to be cutting interest rates 5 or 6 times
No.
during that year. That was sort of the market's expectations. And maybe we'll get to 3 or 4 as we move into year end. And like you said, the Fed will be looking to cut, next week. But beyond that, you've had pretty benign environment. We haven't really seen any sort of material uptick in defaults. We've seen some pockets, but nothing material. And so when you look at the S&P up 17%, broader fixed income, the Barclays aggregate index is sort of the main index, or S&P equivalent in fixed income land, is up almost 5%. Cash is still hanging in there at 5%, though we know that's going to be moving a bit lower. And so between the equity fixed income environment, you've had these blips. We talked about August, right? A little bit here and there. Markets don't go straight up. And so there is expectation of some level of volatility to be had. But overall, I think, even as markets and rates start to come down a little bit, you've had a pretty strong, total return framework, both across equities and fixed income.
I love it. So as we wrap up here, I like to end on a positive note. So what's something that you're excited about either currently or in the future, but what's something you're looking forward to, or like, hey, this kind of excites me. This is why I'm in this industry. This is what I love. What do you kind of see, that's exciting out there?
Yeah, I mean, a couple of things. So if you look to where we've come from in the last 4 years, right? The pandemic is becoming further and further in the rearview mirror, and it's much more the go forward. You're still close to, 50-year lows in unemployment, and you have all of this innovation everywhere, right? Be it AI, seeing what we're seeing in biotech, renewables, et cetera. So I do think there's a ton out there to be excited about. Of course, when you get innovation and newer areas of innovation and excitement, that also perhaps comes with some frothier valuations, kind of people chasing most recent performance, and we're seeing a little bit of that. But overall, I bet there's a variety of companies that you and I and your clients have never heard of that will start coming to the forefront over the next 3, 5 to 10 years. I mean, think about OpenAI and ChatGPT 3 years ago. Nobody knew anything about it, and now it's kind of rolling off people's tongues and being incorporated into so much of what corporations are trying to accomplish over the coming years, and lots of use cases for it. I think about some of the opportunities that we're seeing in real estate. There's been a lot of talk about office and malls and focusing on the sort of distressed area coming out of COVID, but there's a lot of excitement around specific areas for investing, both on the debt, but frankly on the public equity side as well, that we're really excited about over the next couple of years. And so, and then finally, I would just say from an asset manager standpoint, we really think about innovation in terms of what can we deliver to your clients that perhaps they didn't have access to in a sort of daily liquid vehicle like a mutual fund or an ETF, or just bringing to market more thought and intellect around some of the strategies and capabilities. So both from the broader macro, but also within the asset manager landscape. Yeah, I think there's a lot to be excited about. The innovation is there. It's not going away. It's then just being mindful around, what is the best approach to investing and getting access to those categories.
That's awesome. Thank you so much. Again, one of the goals with our calls here is these are the people that we excuse me, if I can talk today, that we rely on to be stewards of your money. So we like just to bring them to the forefront so they're not in the hidden room back there. They're real people helping us out. So we appreciate it so much. We love our relationship with Janice Henderson, and Dan and the team. So again, I want to thank you for taking the time out of your day to jump on and do this for us. So I appreciate it so much, buddy.
Thanks, Jeff. Appreciate it.